Greetings and welcome to today's case study. Today we're going to do a case study on New Zealand USD. That's NZDUSD. So this is the 1 hour time frame. I've looked at the chart. We are bullish on the internal structure. So our main focus is this area. So markets swept broke this high, or let me say swept liquidity. So we had a change of character on the lower time frame. So it was in that change of pattern we took our entry. So we're going for where we took profit is on this 4 hours inside bar here. As you can see now, this 4 hours inside bar, that's where we took profit. So let's go back to the 1 hour. Now this is the 1 hour. Let's go down to a lower time frame to see how the markets move. Now this is the chart on the 15 minutes time frame. For our entry is not that visible on the 15 minutes time frame. Let's go down to another lower time frame. That's 5 minutes. So on this 5 minutes time frame, our chart is now visible. So this is what actually happened. Let's zoom in. So on the market, after we swerve this high here, after growth structure there, we had a flip entry. So markets broke this internal structural high, that the minor structure, it broke this high. Then it came down a little bit, mitigated the demand zone here, went up, mitigated another supply zone, a supply zone here, then came down again to mitigate this demand zone. But this demand failed, the inside bar demand failed this week. So that was a sign that the market was going to drop. The break of this low was a good sign, and another break here of this demand was another sign. We would have said this is not valid. This market mitigated it and broke this high, but since market market broke it and failed to break this high thereafter, and this one also failed, so it was a sign that the market was going to drop. So where we traded from was this supply zone here. We traded from this supply zone. We used here as our engagement to trade down to that 4 hours inside bar demand, which is this. And this trade is 1 is to 32. So let's go down a lower time frame to see what happened in the chart. Now this is the 3 minutes time frame. So here it is clearer. So this demand led to the move of the market reaching this point. Another demand in the market led to the break. So market came down, getted this one, failed to break this high supply here, then came down, also made this place to fail immediately. The market came up to mitigate this supply zone here. So if you are to refine it, this is what it looks like. The market still mitigated the inside bar supply zone there. Now, what we had for this entry is a flip entry. Let's go back to the 5 minutes time frame. So in this 5 minutes, that's where the chart is very clear. So for a flip entry, what we usually have is something of this nature, like this: low, a high, a mitigation of a strong low, and a mitigation of a supply, then a break. So that's what actually had here. So markets broke this high, came down, mitigated this supply, came up. Sorry, it came down, mitigated this demand, came up and mitigated this supply. Then thereafter, started going down. So in both cases, we might find this on the buy market, we might find this on the sell market. But just know that this kind of entry is very, very risky. It's very, very risky. So that's it. So after that mitigation, we now had a change of character, as we know. So that's how the market actually moved. That's how the market actually moved for this entry. In some cases, we might see that the market might break a high, or market might break a high, or it will mitigate a higher time frame point of interest, either in a buy or in a sell. Let me flip the chart so you'll see what it looks like in the buying market. So this is what it looks like in the buying market. A break, the mitigation of supply, then the mitigation of demand for the move. So that's it for this case study. So for this one, what we had is 1 is to 30, 32. 1 is to 32. So we mitigated, we took profit at this high time frame inside bar demand or in point of interest. See you in the next case study.